Hey everyone, welcome back to Finance Friday. This is the show where I answer your burning money questions. This is our special edition of Money Girl, our Friday show. I love getting questions from you, so please keep them coming. Today's topic comes from Paula, who says, I'm getting a late start investing and am unsure about where to begin and how much to save. Can you give me some tips for becoming a more confident first-time investor? Thank you for your question, Paula. I definitely understand that becoming an investor can feel scary, even when you know it's a good idea. Sometimes a lack of knowledge can hold you back from investing, but often I think it's the fear of losing money. This podcast will review how to invest while minimizing risk, no matter your level of experience. I'll give you 7 tips for investing wisely so you feel comfortable and confident about reaching your financial goals. Welcome back, everyone. It's episode 953 of Money Girl. I really appreciate you being with me. If you're new here, I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. You can learn more, ask your money questions, and sign up for The Money Stack when you visit lauradadams.com. When you subscribe to The Money Stack, subscribers automatically receive my Money Success Toolkit with the exact templates I use to manage money. And subscriptions are free, or you can choose to support the show as a paid member and get access to live educational events. All right, let's talk about how to be a confident investor. You know, no one is born knowing the perfect way to invest. And there are certainly many different strategies you can use to build wealth. Some people are very conservative and others feel comfortable taking big risks. I'm going to focus here on 7 fundamentals of investing that I believe can help you become more confident whether you're just getting started or have been at it for decades. Number 1, you must distinguish between saving and investing. I think one of the most important rules of investing is knowing what money not to invest. Everyone should have non-invested savings for short-term needs or goals, like an emergency or something you want to buy in a year or 2. You want to keep savings in an FDIC-insured account, like a high-yield savings, so it stays completely safe and is really easy to access or stays liquid. Now, it's not going to earn as much compared to investing, but that's okay. That's, the purpose of this money, the purpose of savings is to have a cash reserve that's not subject to market volatility. With investing, you buy an asset with the expectation that it will pay dividends, appreciate in value, or both. Investing is appropriate for longer-term goals that you want to achieve in at least 3 to 5 years in the future, maybe something like buying a home and certainly retiring. There are thousands of potential investments like real estate, businesses, precious metals, cryptocurrency, commodities, stocks, and bonds, just to name a few. But I'm going to focus on mainstream investments that are typically available in most taxable and tax-advantaged accounts. Since an asset's value can fluctuate wildly within short periods, saving is always better than investing for your short-term goals. However, over long periods, investing is critical for earning enough growth so that you beat inflation and you can achieve significant goals like retiring. All right, so tip number 2 is you should set savings and investing goals. To be a confident investor, it's important to set realistic goals and perhaps start slowly to avoid feeling overwhelmed. As I mentioned, I want you to first build some savings, and a good target is maintaining a few months' worth of your living expenses in a high-yield savings account. For example, let's say your housing, food, utilities, healthcare, and debt payments total $3,500 a month. You want to make a goal to build up at least that much in savings, and ideally maybe, 2 or 3 times that amount, just depending on your situation. And yes, it usually takes time to accumulate a healthy cash reserve. So set a specific target and then break it down into monthly goals, like saving 5% of your monthly gross income until you achieve the goal. Now, once you've got some amount of emergency savings, maybe it could be a month's worth of living expenses, or it could be, maybe $1,000 or 2,000, just whatever feels comfortable for you. You might continue adding to it monthly while you also are investing. And a good rule of thumb is to regularly invest at least 10 to 15% of your gross income for retirement annually. So maybe you're investing 10% for retirement and putting 5% of your income in a savings account, for example. Tip number 3, you should choose tax-advantaged accounts. If you have a workplace retirement account, such as a 401k, 403b, or 457 plan, that's the best place to begin investing. Now, Paula didn't mention what is available to her, but I always recommend starting there because they do require automatic payroll deductions in amounts that you set. They may also offer employer matching, and they give you some terrific money-saving tax benefits. With a traditional retirement account, you make pre-tax contributions, and that reduces your taxable income for the year. Your earnings and account growth are tax-deferred until you make withdrawals in the future in retirement. You also typically have access to a Roth retirement account, and this is where you pay tax up front on your contributions, but you receive tax-deferred growth and get tax-free withdrawals in retirement. And I always recommend that you take advantage of a Roth, especially when it's available at work. That's because there are no income limits to qualify. With a Roth IRA, which I'll mention in just a moment, there are income limits. And even if you don't receive employer matching at work, it's certainly wise to max out a workplace retirement plan. For 2025, you can contribute up to $23,500 or higher amounts if you're over 50. And if you leave your job, it's really easy to roll over your vested balance into an individual retirement account or IRA. An IRA is available for anyone with earned income, including minors, so it has no connection to your workplace. I think an IRA is the next best place to invest if your employer doesn't offer a retirement plan, or perhaps you're self-employed or are unemployed and you file a joint tax return. You can choose a pre-tax traditional IRA or an after-tax Roth IRA. However, as I mentioned, there is an income limit to qualify for Roth IRA contributions. For 2025, you can contribute up to $7,000 or $8,000 if you're over 50 to either type of IRA, and that assumes that you qualify for a Roth IRA, that your income does not exceed a fairly high threshold. In addition, if you're self-employed, you have more tax-advantaged account options, including a SEP IRA and a solo 401k. They have much higher annual contribution limits, such as $70,000 or higher, depending on your age and business income. All right, my fourth tip for becoming a confident investor is that you should build a diversified portfolio. Once you open a retirement plan or a taxable brokerage account, you'll need to choose from a menu of investing options. I recommend building a very simple but diversified portfolio, and that simply means owning many investments that react differently to economic events. For instance, if you only own one company stock, its market share could decline or the company could get bad press, causing its stock value to plummet, exposing you to a lot of risk. A better strategy is investing in one or more funds, which are baskets of many securities like stocks, bonds, and other assets. So if some of those underlying investments in a fund lose value, some are going to hold steady, and some may increase in value, minimizing your risk. So here's a brief overview of the types of funds that make it convenient for investors to get instant diversification. You're going to see mutual funds pretty much everywhere. These are collections of assets managed by a fund professional at a fund family, such as Vanguard or Fidelity. You can only buy or sell mutual funds at the end of the trading day when the fund's net asset value and share price are calculated. Exchange-traded funds, or ETFs, are very similar to mutual funds in that they are collections of assets. However, they trade differently. You can buy or sell ETF shares throughout the day because they trade on markets, kind of like an individual stock trades throughout the day on a market. Index funds can be mutual funds or ETFs that aim to match or outperform a specific index, such as the Standard & Poor's 500 index. They typically come with low fees and give very broad diversification. And target date funds are another popular type of fund. They can be mutual funds or ETFs that automatically reset the mix of underlying assets according to a future date, such as the date you plan to retire. So all these funds do come with fees that are known as an expense ratio. And in general, it's best to choose lower cost funds to avoid unnecessary costs that lower your return. So when you're choosing funds from a menu, make sure that you not only look at the historical returns, but look at the fees that are charged. My fifth tip is that you should be consistent. Instead of investing a lump sum when you have extra money, consider the benefits of regularly investing a consistent amount, such as weekly or monthly. This is actually a strategy called dollar cost averaging, or DCA. With DCA, you buy chosen investments regardless of their prices, which are likely to be different each time you make a purchase. For instance, let's say you want to max out an IRA by contributing $7,000 over a year. That would be $583 a month. A DCA strategy can make investing less emotional because you're going to stay focused on how much to invest each month rather than on the price of the investments from week to week or month to month. By sticking to a DCA strategy over the long term, you actually smooth out how market fluctuations affect your investment portfolio, and that makes you less vulnerable to bad market timing. In other words, if you were to invest a lump sum when a fund's price is at an all-time high, you'd lose money and probably never have the chance to recover. I also like how a DCA strategy allows you to automate investing, keeping you on a predetermined schedule, which can also be easier on your budget. That's a great way to make investing a habit that you're likely to continue, even when an investment's value drops. Instead, when an investment's price falls, you see it as a chance to buy more shares that month. In general, dollar cost averaging is best for investors with a long time horizon who don't necessarily have a large lump sum to invest or want to worry about timing the market correctly, which is virtually impossible. You don't need any experience or expertise to implement a DCA investment strategy. In fact, if you're enrolled in a workplace retirement plan that requires regular contributions from your paychecks, you're already using a DCA investing strategy. My sixth tip is that you should ignore what you can't control. Short-term volatility in the financial markets is uncontrollable. So staying focused on building long-term wealth is critical for success, and I think for confidence as well. What happens in the markets from day to day only matters if you need to liquidate or spend your investments right away. As I previously mentioned, money you need in the short term should never be invested in the first place. Confident investors tune out media hype, they ignore stock tips from friends and family, and never make rash decisions like selling investments when their value drops. Your goal should be to get investment growth over many years or decades, not month to month. And my seventh tip is that you can ask for investment advice. Most investing platforms and robo-advisors help you choose specific investments by asking questions about your age, timeline, goals, and risk tolerance. They may have an online quiz that you complete before they recommend a suitable portfolio. In addition, many investment firms have a human advisor you can use for free, especially for workplace retirement plans. So, don't squander the opportunity to get that free advice if you need it. However, if you have a complicated situation, don't hesitate to consult with an independent financial advisor. Paying for specific advice or to get a holistic financial plan from a certified financial planner can give you incredible confidence that you're on the right path. So, Paula, to sum up, being a confident investor starts with having enough savings and then investing money earmarked only for long-term goals. You can reduce investment risk and smooth out volatility by choosing diversified funds and regularly investing smaller amounts. And getting help from an online tool or a human advisor can help you choose the right investments and know how much to invest to reach your unique financial goals. Paula, thank you so much for your question. If you haven't already opened a retirement account like an IRA, that's definitely the first place to start. You're going to open it up and fund it with an amount that's comfortable for you, and just set a goal to set aside some amount, choosing, again, a diversified fund or two that has low fees, and make a goal to just put a regular, consistent amount aside, and maybe you'll be able to increase that over time where you're going to put in a larger amount of your income until you can max it out. And then if you have more money to invest, you can always use a taxable brokerage account. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast, and I want to thank our terrific team. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist, and Nathaniel Hoops is our marketing contractor.